Welcome to Trader TV, your insight into trading for professional investors. I'm Dan Barnes. Investments in emerging markets is booming this year as people seek out higher yields. However, trading costs for trading in emerging markets are typically higher than for developed markets. Today we're speaking with Tom Nickalls, fixed income trader at Asset Manager 91, and Craig McLeod, head of emerging markets at platform MarketAxess, to discuss how buy-side traders add value to the investment process. Tom, Craig, welcome to the show.
Thanks for having me, Dan.
Hi, Dan. Thanks. Nice to be here.
To start with, are trading costs for emerging markets funds actually higher in fixed income than they are for trading of developed markets fixed income?
On an aggregate basis, emerging market trading costs are higher than developed market trading costs. But it's very, very simplistic to cover all of EM under one umbrella.
Right.
EM fixed income consists of three separate debt classes, and it spans across 30 very discrete economies. And the net result of all that is a real broad spectrum of liquidity that's constantly evolving.
Some portions of EM are extremely liquid. Chinese local bonds, some portions of sort of Middle East IG credit trading costs are very low and almost comparable to developed market counterparts. I think one point that sets EM apart is that during periods of volatility, the effect on EM trading costs is just a lot greater than developed markets.
What are the causes of additional cost, and which of those causes are manageable?
Your potential investors for a US Treasury are absolutely huge. If you look at EM potential investors, it's just a lot smaller pool. So you've got locals, your pension funds and the like, you've got dedicated EM money, and then also kind of crossover tourist money, you could call it. Dealers have less places to go to manage risk, and as a result, bid-offer spreads naturally increase. The volatility means they have to give themselves more of a chance to cover that risk without losing money. So as a result, bid-offer spreads widen.
Volatility clearly does test dealer liquidity and dealer balance sheet. And during those times, even if we use the recent pandemic as a case study, clients tend to desire more liquidity options. So one of those options is the all-to-all marketplace, where clients can obtain pricing or liquidity from institutional investors, domestic investors, maybe some of this tourist money that Tom alludes to. And a key benefit of that really is kind of cost savings. When you've got more participants contributing to liquidity, you're naturally going to get better costs.
We are hearing of more crossover money entering the space and a general kind of search for yields. So that added, investor interest should help us in the long run.
How is a buy-side trader adding value to the investment process in emerging markets?
Asset managers today are now harvesting a significant amount of data, and they're pushing it right to the start of the investment process. So what's really happening is the marketplace is becoming a key part of the investment decision. And this data contains firm pricing, axes, anonymous liquidity, smart and predictive data. And what this has done is really improved the likelihood of trading, and it reduced transaction costs and slippage.
EM markets are still very fragmented. So market color around flows, technical factors, particular liquidity squeezes perhaps in different sectors or credits is crucial for an EM trader to give this technical insight to create a more rounded view. The execution of large trades in these markets is also alpha generating, making efficient decisions on which dealers to choose and who to partner up on in large illiquid securities is crucial to ensure that we get good execution outcomes.
Trade automation is the first major building block to empower a trader to add value. And that's something we've seen with our AutoX capabilities at MarketAxess. And conscious of cost-saving benefits through open trading, what we're starting to see is clients respond like a dealer through our open trading network. This has become so prominent, we're in the process of developing a bit of technology, what we call autoresponder, which systematically enables a client to respond through open trading, hands off the wheel to reap these huge cost savings that they want to obtain.
And then what challenges and risks do you actually face when you're attempting to add value?
Improving trade data we get back from fixed income markets, we've still got a long way to go on that front, but it's improving all the time. And feeding that back into the investment decision making to create that alpha generating opportunity. One thing I would say is that sell side relationships have never been so important. So ensuring that we enhance them and foster them Dealers have got balance sheet constraints, and they need to be able to trust us when we trade with them to do things the right way. And that means that those relationships are as key as ever.
How do you see market structural changes affecting the execution choices that you have?
There's a constant evolution of technology and regulation that we've got to be ready to adapt to. For example, all-to-all trading is increasing in market share. We're also seeing a rise in ETFs, which is creating another technical dynamic to watch in credit markets particularly. And also the ETFs are now becoming liquidity providers themselves. Investment banks are looking at different ways to interact with the buy side. So we've just seen the acquisition of LiquidNet by ICAP as an example of that. So we need to be ready to kind of adapt to those types of changes to ensure that we're still getting the best liquidity possible.
Market structure of fixed income is evolving faster than ever. And for the first time, I'd probably say regulation and technology are working hand in hand. And a byproduct of that interaction is the increase in available trade data, stimulating new marketplaces or new sources of liquidity. We've recently launched what we call our live markets. So live markets is a central limit order book for credit that's going to slowly fold into emerging markets. So what's really happened is the increased available data has enabled dealers to systematically price thousands of bonds to clients in real time.
I wanted to ask about electronification of the markets. Clearly, you've given some good examples of that. So presumably you see this leading to better execution choices ultimately.
Absolutely. Clients are spending a lot of time with us stretching the boundaries of e-trading. The discussions have really homed in on maximize my trading protocols and maximize my liquidity opportunities. So for example, recently, beyond the RFQ, we've built Request for Market, a two-way pricing protocol that's really familiar in FX, but now is in EM, debt. We've also taken all our participant pool and created what we call MidX, which is a session-based protocol that effectively blends clients and dealers into an anonymous auction, maximizing everyone's ability to trade at mid. So that was a real huge ask from our clients across the globe, particularly in EM. And the third piece is portfolio trading. As indexation has increased, portfolio trading is only really starting to come to life just now in EM, but it's definitely an emerging trend.
Building on the data we're getting back is a crucial step, and the further electronification of markets will help that. But we need to remember that sell-side relationships are as important as ever, and electronification isn't going to be a one-size-fits-all. So we still need to remember that whilst we've got countless numbers of platforms to trade on, those close relationships with the sell side are important because we're not going to be able to trade everything on electronic markets in the future, just like we can't now.
Craig, Tom, thank you very much.
Thank you.
No problem. Thanks for having me.
I'd like to thank Tom Nickalls and Craig McLeod for their insights today, and of course you for watching. To catch up on our other shows or to subscribe to our newsletter, go to tradertv.net.